Hello, everyone, and welcome to Thursday's edition of our Center for Online Learning. I hope you've all had a good week, and we have another great webcast ready for you. It's entitled Preparing for the Impact of the Preparing for the Impact of the Pandemic on Your Pension Plan. My name is Hank Kim, and I'm the Executive Director of NCPERS. Today's program is part of our expanded Center for Online Learning. As we all adjust to the new COVID reality, please bear with us if there should be any technical issues or unplanned background noise during our session. As always, your patience and understanding is appreciated. We encourage audience participation. Please submit questions by using the GoToWebinar portal. However, to ensure that we can cover all our topics, we will hold your questions to the last part of the program. And additionally, in the handout section, you will find a PDF of today's presentation. Today's webcast is sponsored by Cheiron. Cheiron is an independent, full-service actuarial consulting firm with a reputation for integrity, creativity, and technical prowess. The firm is known for its pioneering work with public pensions, particularly in measuring and managing risks. The firm advises many of the nation's largest public and Taft-Hartley plans, as well as health and welfare plans. The firm is often asked to advise financially troubled plans to help navigate through difficult times. Joining us from Cheiron are Gene Kowalski, who is the co-founder of Cheiron. He is one of the most highly respected pension actuaries in the nation. For more than 40 years, he has advised multi-billion-dollar public pension and Taft-Hartley plans. His experience includes serving as plan actuary to some of the largest multi-employer plans and numerous state, county, and city funds. Also joining is Bill Hallmark, who is a nationally recognized retirement consultant with more than 3 decades of experience advising pension plans. He's a frequent speaker at public pension conferences on topics including principles of funding, risk metrics, disclosures, and financial reporting. Gene, Bill, the webcast is yours.
Thanks, Hank. Good afternoon and good morning, everyone, depending on where you're at. COVID-19 pandemic has disrupted the world. Over 4 million infected, over 300,000 deaths, no natural immunity, proven treatments or vaccine. Significant parts of the economy are turned off. There's significant federal stimulus. Investment markets are in turmoil, although quite good recently. And there's no comparable experience in our lifetimes. This is nothing like 2008, and we'll get into why we say that. But we believe that most state governments are already seeking ways to make up for substantial losses of revenues. Many are likely to pressure public plans to accept lower contributions, and so the purpose of this session is twofold. We'd like to show you how can public plans most effectively deal with these pressures, and there's 2 goalposts on the options. You can resist, or you can be flexible. And the second objective of this session is that if plans are flexible, how best to proceed. I'm going to turn it over to Bill, who's going to talk about the pandemic in general, and then I'll come back later on.
Thanks, Gene. As Gene indicated, we're facing a situation that we've never seen before, and the future depends on a variety of critical factors on which we are not experts. So in order to develop a strategy to manage our pension plans, we'll need to assess opinions and forecasts of relevant experts and consider multiple potential scenarios and how they would affect a specific pension plan. Let's go to the next slide. An analysis of the current environment for public pension plans starts with the state of the pandemic. There are a variety of different sources of data on the pandemic, as well as different projections of where it will go from here. We all know we experienced an exponential growth of cases and deaths in March, reaching a peak in April and declines throughout May. The pattern we're seeing, however, is heavily influenced by New York. Other parts of the country are experiencing increases in the number of cases, as New York has seen a rapid decline. The number of new reported cases appears to have leveled off at about 150,000 per week, but it's difficult to know if this is due to expanded testing or reflects the beginning of a new wave driven by the easing of stay-at-home orders and/or the spread of previously unaffected parts of the country. There's a lot of uncertainty about where the pandemic goes from here. Will we have a new wave, a series of waves, or will it burn out? How soon will we develop effective treatments or a vaccine? And once we have a vaccine, how quickly can we inoculate everyone? Next slide. The pandemic has also caused enormous disruptions to the financial markets, with the S&P 500 falling about 34% in 1 month and generating many news articles about the potential demise of public pension plans. Most public plans, however, operate on a June 30th fiscal year, and there were significant investment gains during the year before and after the 1 month drop. At the end of May, a 60-40 portfolio would have a return of almost 5% for the fiscal year. Most assumptions are higher than that, but it doesn't appear to be a significant investment loss so far. Markets still appear unsettled, and there is another month left in the fiscal year, so we'll have to see where it ends up. Next slide. The pandemic and the ensuing stay-at-home orders imposed a hard stop on parts of the economy. Unemployment has increased dramatically, while interest rates and inflation have dropped to very low levels. There's significant uncertainty in how quickly the economy will recover as we reopen. There are a variety of forecasts out there, but there's not a whole lot of consensus as of yet. Some forecast a relatively quick V-shaped recovery, while others forecast a long and slow, drawn-out recovery. Go to the next slide. With the downturn in the economy, the big issue for pension plans is that there's been a significant drop in state and local tax revenues. The impact varies depending on the type of tax, but forecasts are showing significant budget shortfalls across the country. At the same time revenues have dropped, states have experienced increased spending needs, including for unemployment insurance and Medicaid. So far, Congress has provided financial support for increased COVID-related spending, but not to replace revenue declines due to the recession. The Fed has provided a liquidity facility so governments can borrow funds, and there is the possibility of additional state and local government support from Congress. In the immediate term, we believe these budget shortfalls represent the most immediate threat to public pensions, as it may be difficult to make the scheduled contributions if revenues and budgets don't improve. With that, I'll turn it back to Gene to look at some of the options being considered.
So the plan sponsors that are facing these revenue shortfalls, what options will they be considering? I believe some will be looking at pension cuts, whether it be for new hires or existing employees if allowable. You'll be seeing some plans offering early retirement incentives to lower the payroll costs. There'll be some entities that will furlough or lay off employees for a temporary period of time. Pension obligation bonds may become popular in these days of low interest rates. And finally, you've got some governmental entities that will short the pension fund and not make the full contribution. So from the plan's perspective, the primary duty of the plan is to protect the long-term sustainability of the plan. Maintaining the long-term sustainability of the plan, it means you ensure that all benefits are paid. But all benefits can't be paid if you don't also maintain sustainable contributions. So it's our opinion that we can't be blind to the other immediate government needs, containing the spread, treating the infected, protecting the vulnerable, restarting the economy, because addressing those needs may in fact improve the long-term sustainability of the plan. But no answer fits for all plans. Every plan's got to find their own path, and it may vary significantly depending upon your situation. So I mentioned the goalpost. On the one end of options is just to completely resist, and there will be some plans, as you'll see in some of our examples, that may need to do that or else suffer some dire consequences. On the other hand, this is a cartoon recently, a few weeks ago, in P&I showing the plan sponsor and the plan need to really, they're in this together. And so there needs to be some flexibility and collaboration. So we're going to take you through some modeling, and there's a lot going on there. So as not to confuse you, I'm going to orient you to what you're seeing here on the screens that will follow. The first thing is there's a couple of graphs. And as we go through each screen, the top graph will represent the liabilities. Those are the gray bars. And then assets are the lines. It's the market value and the smooth value. Then the funded ratio appears at the very top of the top chart. The bottom chart's a little bit simpler. It's those gold bars are simply the employer contribution dollars going into the plan. And what we can vary in each plan, on the left-hand side of the screen, you'll see three columns. Investment returns, you'll see payroll growth, and a column called adjust contributions. Everyone is familiar with investment returns and payroll growth, but wherever you see green or red, that means it's good news or bad news. And when it's red, that means it's below the 3% assumed payroll inflation. And when it's green, it's above that. And on the adjust contribution, that's saying, well, what if we don't make the full ADC? And we can also play with historical rates of return. On the top in the middle of the graph, you'll see, well, there. You'll see funding inputs, amortization periods. The current UAL is set at 30 years in this example. And if the plan is shorted some contributions, how quickly are you going to require that to be made up? So those numbers can vary. And below that is a phase in, phase out period, which I'll let Bill explain when he gets to his charts. And finally, there's a choice between having an ADC plan, that's a plan that makes the actual determined contribution, or a fixed rate plan. There's several plans out there that have their rates statutorily fixed. And when that option is chosen, you won't see any amortization periods. So we'll start with Plan A projections performed as of the completion of the July 1st, 2019 valuation. We started here with a plan that's 75% funded, has 20-year amortization periods for its unfunded. And on the left-hand side, the plan earns 7% each and every year, 3% payroll growth, and there's no reduction in the ADC contribution. The full amount is made. Plan gets fully funded, and you see nice level contributions as a percent of payroll, they would be level. But now, as of June 1st, the situation has changed. The plan actually reports for this plan that the return for the year to date is minus 1%. And the plan has learned from the either the governor or the state legislature, there's going to be reductions in force to the tune of, at least in the first year, of 25%. Then gradually work its way back up to 3%, the assumed rate of return. So if you look at this chart, it's not dire. The plan still gets 100% funded, and contributions are going to be a little higher because you're spreading that losses that are occurring here. But you don't see that much of a difference. But let's say in this plan, the governor or the legislature's requests to short the plan. So now on the left-hand side, that third column, we have a minus 99%. That means virtually the entire ADC is not paid in 2021. And that's shown in the bottom graph. And the top graph, we still get to 100% funding because it's a 20-year amortization of that missed contribution. But if the plan rejects the shorting of the contribution and the state or the county has no other way of filling in the revenue gap, they may need to go deeper with their layoffs. So now, if you look at the second column on the left, you've got 30% drop and then a 10% drop, and it takes 6 years to work its way back. So the question is the plan better off facing this scenario or facing the less drastic cuts in payroll and accepting the 1-year contribution shortfall? And to compare the two, there's a red line that's superimposed on here. And the red line is showing what the result would have been prior to the shorting of the contribution. And basically, there's not much difference at the bottom, but on the top graph, you're seeing a significant drop in where the assets would have been. That red line on top is where the assets would have been if with the lower levels of furloughs and no shorting of the contribution. But what that really represents is lost people. And this might be a candidate, this plan, to consider some flexibility so as to not have further layoffs than we had in the initial projections as of June 1st, 2020. So one of our first conclusions is that some plans that make the ADC payment and are relatively well funded should perhaps be flexible, but we'll get into that later. Another type of plan, a fixed rate plan, and we'll show here is fixed rate on the top. There is 17% of payroll. So regardless of what happens to experience, investment returns or payroll or shorting of contributions, that fixed rate stays the same unless somehow it's statutorily changed. And that's this as of 7/1/2019 valuation. But if we roll forward on the fixed rate plan to June 1st, 2020, where we pick up the -1% return and the initial projections of furloughs of -25% in 3 years to ramp up, here you start seeing some serious problems going on. If you look at the asset and the funded ratio, it's dropping to 57% at the end of the period. But contributions will just remain 17% of payroll, so nothing strange is happening there or significant. And now if this plan is requested to make a contribution, take a contribution holiday or let the plan sponsor have a holiday, the funded ratio is even worse for this plan. It's down to 50%. And you see that missed contribution there at the bottom graph. And if the plan rejects that 1-year shorting of the contribution and the payroll declines are even worse, I'm seeing it on my screen.
There it is.
Now we've got a situation where the plan is actually heading towards insolvency. That's the green line in the top chart. If we extended the projection another 10 years, this plan for missing the 1-year contributions and having the more dire reductions in payroll is heading towards insolvency. And we compare it to where the plan would have been with the June 1st projections that had the -1% and the less substantial payroll reductions. And you see the contributions are substantially less than the red line in the bottom graph. So for fixed rate plans are certainly going to be far more sensitive than the plan that pays the ADC as far as considering any type of contribution holiday. So our conclusion here is that for plans that pay the ADC, some flexibility might be considered, but with the fixed rate plan, not as much. But it's not only important to say that some flexibility can be offered, it's also very important to know how to offer that flexibility. And Bill's going to describe how best to do that.
Thanks, Gene. Gene presented those options offered by the employer as sort of a take it or leave it option. And while it depends on the situation, I'd think of it more as an opening in a negotiation. The employer is trying to balance their current budget and expressing a need to have a contribution holiday. We need to analyze and communicate the potential impact of that proposal and propose alternatives to protect the long-term sustainability of the plan while trying to accommodate any real and immediate budget needs. If the plan accepts a deferral of contributions, we need to see how quickly the plan can be put back on a sustainable path to full funding. The approach needed will depend significantly on how contributions are determined. So I'm going to look at plans that pay an actuarially determined contribution first, and then plans that pay a fixed rate set in statute. Next slide. So plans that are required to contribute an ADC have some key advantages. The plan and the actuary will need to sign off on any contribution deferral. Future contributions can be increased based on the needs of the plan. As a result, these plans can often afford to be more flexible as they find a path towards recovery. The objective really is to find the path with contributions high enough to fund the benefits over a reasonable time period, but not so high that the sponsor can't afford to make the contributions. Lower contributions today generally increase the risk of unaffordable contributions in the future. But the current drop in employer revenues may make current contribution levels no longer affordable. We need to think of the contributions in terms of percent of revenues or budget instead of just percent of payroll. It doesn't help the long-term sustainability of the plan to insist on an unaffordable contribution today, particularly if you are confident higher contributions will be more affordable in the future. So if a plan can be flexible in the short term, how does it make sure it's able to recover without imposing or increasing the risk of unaffordable contributions in the future? Next slide. If the plan acquiesces to a contribution holiday, consider a short-term recovery plan. Normally, we would just treat the missed contributions as an actuarial loss and amortize them like any other actuarial loss. This chart shows the projected contributions from Jean's example under the contribution holiday proposal. Contributions are increased slightly for 20 years, but the plan doesn't return to its prior projected funded status until the end of that 20-year period. Instead, particularly if you expect a quick return to prior revenue levels, think about a short amortization period for any of those missed contributions. This line shows a 5-year amortization of those missed contributions, and that gives you, after 5 years, the funded status is back on the same path as if the missed contributions had been made on time, and the contribution levels also return to the prior projected amounts, giving you more flexibility going forward to stay below the limits on affordable contributions. Let's go to the next slide. Another approach to consider in these extraordinary circumstances is to use phase-in and phase-out amortizations. It's a technique developed by Alan Milligan when he was at CalPERS, and the technique imitates the amortization payments on an investment gain or loss reflecting asset smoothing, but without using any asset smoothing. In the example here, we're going to look at 4-year asset smoothing, and so 25% of the loss is recognized in the first year and amortized over 20 years. And then another 25% is recognized in the second year and amortized over another 20 years, and so on. You get the third period of recognition and the fourth. Instead, you can phase in the amortization payment at the beginning and phase out the amortization payment at the end and get the same result. This technique can be applied to other gains and losses and has also been applied to assumption changes. The phase-in out period should be relatively short, probably in the 3 to 5 year range. So let's go to the next slide. We're again looking at the projected contributions from the employer proposal. Now, the phase-in and out amortization won't result in a complete contribution holiday because you're going to still pay the normal cost plus a piece of an amortization payment on the UAL. But if the need for a reduction is less severe, or you can negotiate a larger contribution in the first year, it can provide a nice stair step back to higher contribution levels, hopefully as revenue improves. At the same time, consider reducing the total amortization period, particularly if it is longer than 25 years. In the example, the amortization period has been reduced from 20 to 17 years with the 4-year phase in and out. Notice that the phase out period also helps provide a smooth transition at the end of the amortization instead of having contributions drop significantly in 1 year. So if employers are required to contribute an ADC, plans may have a fair amount of flexibility to use these techniques. But you also need to monitor net cash flow levels to make sure assets are not severely depleted in the short term or that liquidity needs don't exceed the plan's capacity, and the short-term growth of the UAL due to the temporarily reduced contributions. So now let's switch to fixed rate plans. Next slide. Fixed rate plans face a different and often more difficult issues. Even if there's no contribution holiday, any reduction in payroll reduces the contributions received, and most importantly, reduces any amount that was being paid for the unfunded liability. A contribution holiday only makes things worse unless it improves the future payroll. A fixed rate plan can recover either through increases to the fixed rate or higher growth in payroll, or a combination. Unlike a plan that contributes an ADC, the fixed rate usually can only be changed through an act of the legislature, which can be a heavy lift. In this chart, we're showing the projection of funded status from the example Jean showed earlier. And the plan starts at a 75% funded status and is projected over 25 years to decline to 50%. In order to recover to the 2020 funding level in 25 years, by changing the fixed rate, the plan would need to increase its fixed contribution rate by about 35% over a 6-year period and hold it at the higher rate for the remainder of the projection. That can be a significant lift. A faster recovery would require even higher increases to the fixed rate, but they might be able to be imposed on a temporary basis. You'd need to run some projections and look at alternatives. Now, if you can't increase the fixed rate, let's go to the next slide. The plan would need to rely on payroll growth to recover. So starting again with the projected funded status here, in order to get back to that 75% funded status, the plan would need to average about 10% annual payroll growth over a 7-year period to get back there in 25 years. That may not be a realistic projection. Show the line. These dynamics for fixed rate plans underscore the importance of considering the macroeconomic environment, both in terms of risks to the plan and easing the burden of recovery. Economic growth and payroll growth make the pension plan's funding problems much easier to manage, and they're more significant than the contribution holiday. Short-term flexibility on contributions can enhance the economic growth or preserve payroll. But, and it's a significant but, if the economic growth doesn't materialize, the results could be very painful for the pension plan. So with that, I'll turn it back to Gene to provide some of our conclusions.
Thanks, Bill. So our conclusions are the pandemic and economic situation of the future is just very uncertain. No one knows where this is heading. Revenue losses and the resulting budget implications are more likely to have an immediate impact on pensions than investment returns, and that's why we say this is not 2008. Many pension plans can be flexible, while others will need to resist any reduction in contributions. It's got to be looked at on a case-by-case basis. But if contributions are reduced, the sooner they're made up, the better the plan's off. So we actually were quite efficient and finished our presentation in about 30 minutes. At this point, we'll entertain any questions people may have.
Great. Thank you, Gene. Thank you, Bill. There is a question. The questioner is asking, give me a second. We are doing our 1/1/20 actuarial valuation. We are down 10% for the first 4 months of 2020. We expect returns to be flat for 2020. Should we use 0 as the discount rate for 2020 and the expected return for 2021 and beyond?
All right. I don't think you would use 0 as a discount rate assumption. If you did projections, you could use 0% for the expected return for that first year and then return back to the assumed rate. But I don't believe 1 year's investment return, high or low, necessarily changes the discount rate. Bill, do you have anything to add?
I would agree that that wouldn't cause you to change the discount rate, but you might look at what the impacts are and what your current contribution policies going to do and what the impacts are with that investment loss.
There is another question. Do you see any changes to asset allocation based on COVID? And do you think that would be advisable?
So I'd say we're actuaries and not investment consultants. And, I started off saying we have to look at the disruption in the markets, but also rely on experts in those fields to guide us through this time. And I would definitely look to the investment consultants for that advice rather than the actuaries.
But what the actuaries can add is if the investment consultants provide that advice, we can provide some stress testing projections so the trustees can see either way what the implications are for their plan.
Another question is, how would the maturity of the pension plan impact the projections in the presentation?
I'll start, Bill, and you can have it. To the extent the plan is more mature, that means more money's going out the door than coming in. But that is something that's more impacted by investment returns. And if you saw Bill showed a chart that returns for at least the June 30th fiscal year are running around 5%. So it would have made the examples a little worse. And that's why we said each plan is different and the path they take is going to be different. And Bill, you have anything to add on that?
Yeah, so I do think the primary impact for a mature plan is that they will be more sensitive to the actual investment returns. And so a drop in those returns will be more painful. But the other secondary impact is that their payroll tends to be smaller compared to the plan as a whole. And so adjustments to that payroll and adjustments to the needed contributions can be a significant part of the sponsor's budgets.
But the general answer is that mature plans do face more risks than plans less mature.
So there's another question about the impact of COVID mortality on the overall mortality table. Do you anticipate that to impact mortality tables going forward?
I think until we get out of this, it's going to be hard to say. As Bill mentioned in his earlier remarks, those declines in deaths were highly attributable to New York State, and there's still spiking going on elsewhere. But I don't know, Bill, when we get out of all this, what's your thought on that?
Well, we absolutely need to see data, and it's going to affect different plans around the country differently. We know we're getting information on total deaths, but we don't know how many of those deaths are for covered populations. So there may be, we've seen a lot of concentration in different minority populations, and it's, so the effect on our pension plans is unknown. It'll take a couple of years for this data to get into the projection scales that the Society of Actuaries issues. So it's going to take a while before we know the full effect. However, I don't expect the full effect to be large compared to the other effects that we're seeing.
Okay. Another question is, what if a plan uses a fixed rate for the unfunded liability, but an ADC rate for the normal cost?
Well, gains and losses can only be made up through the UAL, and if that's fixed, you got the same issues. It may ameliorate, it may make it a bit better because you're always paying the normal cost. The normal cost is going to be pretty stable unless you have the workforce declines. And in the examples we showed, actually it could be worse, because if you're only paying the normal cost and you have 30% decline in payroll, you're actually going to drop that portion of the contribution while keeping the UAL fixed. So I could see scenarios where that's even worse than what we showed today.
Okay. Bill, do you have a comment or no?
No, I think Gene covered it.
I guess the final question is relative to being, allowing the plan sponsor to be flexible. And certainly, I think we all recognize that we are in unprecedented times. But to those who may argue or insist that this may be the camel's nose under the tent, and as a result, this may be the beginning of a slippery slope. How would you all respond to that?
That's an excellent question, and we actually anticipated that ahead of time. And it'll depend on each situation. Is there a way to somehow put in writing that this is purely a one-time event? We probably need help from fund councils on this score, but certainly there would be some entities, once you open the door like this, that may find it helpful elsewhere. Bill, what are your thoughts?
Yeah, I think one of the issues in the metrics we've watched over the years is whether the employers are paying the actuarially determined contribution. And so even in this extraordinary time, I think it's important, if you can avoid crossing that line. And so it would encourage then some collaboration and work between the employers and the plans to try and figure out an actuarially determined contribution that can both meet the immediate budget needs of the employer and fund the plan sustainably over the long term. And so that sets up more of a negotiation to work through the process and prevent the employer from crossing that line.
So we got a couple of follow-up questions. One follow-up question relative to the mature plan, and it is, what are the relative impacts of contribution and investment returns on mature plans?
Say it again, Hank.
What are the relative impacts of contributions and investment returns on mature plans? Bill,
are you?
Yeah, so mature plans are, by definition, larger compared to the size of the sponsoring entity than immature plans. And so the investment returns become a larger piece compared to the budget or the payroll of the sponsoring entity. And as a result, the contributions can be a lot more volatile, reacting to those changes in investment returns, but also other types of changes. The contributions can be more volatile. If the mature plan is poorly funded, contributions likely are already very large. But if it's well funded, those contributions could be relatively low. So it's more the impact on the volatility of those contributions and the changes needed as the plan experiences changes.
Also, the size of the assets relative to payroll is a factor there. That the higher that number is, the more the volatility increases.
The other issue for those plans, if they are low funded plans, they would really need to watch the net cash flow, because they will tend to have large benefit payments going out in comparison. And if you do something like this where you're being flexible, that could create some very large negative cash flow that could really deplete the plan in the short term. So large, mature, poorly funded plans really need to watch the net cash flow and make sure the contributions are sufficient.
We have another question. Gene, you started off, or at the early part of yours, today's webcast, you mentioned pension obligation bonds. The questioner is asking, if a pension obligation bond were issued, how would it impact your conclusion or the plan's risk?
Well, I have mixed feelings on pension obligation bonds. You're basically getting a pile of money at low interest rates and then putting it back into risky assets. So in some ways, you're increasing the risk of the plan. But on the other hand, if it's a choice between that and a severe shortening of contributions or significant layoffs, I think it's worth taking a look at it and the implications and studying it. You agree, Bill?
Yeah, I think no matter what, it adds leverage to the plan, which increases the investment risk. And when you take into account the payments on the pension obligation bond. So you need to take that into account and analyze it and make sure you're not getting to a situation where the risks are too much to bear.
All right, we have another question. The questioner asks, our trustees are frequently criticized for not meeting their fiduciary responsibilities if they worry about an employer's ability to pay. How can we make the point that affordability affects the ability to continue making benefit payments?
Because you just take a look at what's happened with plans already, plans that didn't care about employer affordability, where these plans may have been frozen to new hires or less generous benefit tiers took place. So bad things happen to their participants. And so you need to at least be concerned with the affordability. In fact, I had one slide that said that sustainability, long-term sustainability of the plan requires that you ensure benefits are paid. But if you don't worry about those contributions being sustainable, it may be that the benefits won't be paid. And all you have to do is look at plans out there that have frozen.
So we already do take into account affordability constraints on employers. One of the objectives of any of our methods is predictable and stable contributions. And the only reason we're doing that is to make the contribution pattern fit into the budgets of our sponsoring employers. If we didn't need to take into account the volatility on the employer's budget, We wouldn't use asset smoothing, and we wouldn't use amortization. We just ask the employers to pay for the UAL right now. But that's not realistic. And so the question is, how do you find a reasonable path to full funding? And you can't flip to the other side and just defer contributions into the future forever. So you need to have a reasonable path that gets you to full funding that can work within an employer's budget.
Great. Bill, Gene, thank you so much for your time today and this great presentation and the wonderful dialogue we had today with the audience members. To the audience members, I say thank you for joining us. Please join us again next Tuesday on June 9th when we host ransomware, hacking, data breaches. What are you doing for protection? Gene, Bill, have a good weekend. Thank you, everyone.
Goodbye, everyone.
Thank you.